Very good. Well, let's get going here. So thank you everyone for joining us today, and welcome back to our annual monthly workshop series. We're eager to share our latest insights on the markets and the economy with all of you today. Now, if you don't know already, my name is Jason Dahl. I'm a certified financial planner and a partner at AFS Financial Group. And of course, I'm here today with my colleague, Alp Batabec. Alp is the founder and managing partner of AFS. I know we have a few folks tuning in from the AFS 401k side. So just as a quick reminder, we at AFS Financial Group operate as a separate entity from the AFS 401k Retirement Services team, but we often collaborate, especially when it comes to financial wellness programs such as our webinars. And also a quick reminder, please ask questions at any time during today's session. I know we received a few questions ahead of time, and we will definitely address those. So thank you for that. And if you're not familiar, of course, you can ask a question by typing it into the Q&A link. That there should be a little control bar. Option to click Q&A and then type in a question. We will keep everyone muted during the presentation. So feel free to fire away any question of any sort at any time, and we'll keep an eye out for that and address those. I got to say, I think our favorite question is, can I schedule a time to speak with you, Jason or Alp? And we want to encourage you to please do that. So directly follow up with us after the webinar. If you have any questions related to what we're talking about today or anything else, we'd be happy to schedule a time to review things with you over Zoom, over a phone call, or in person. We continue to love what we do, and the best part of what we do is connecting with folks like yourself and helping you solve personal financial planning puzzles. So please don't hesitate to reach out. Without further ado, let's get right to our obligatory disclaimer slide. And this is not meant to be an endorsement or recommendation for any particular investment. It is for educational purposes. And if you're listening to the recording, just please note that this is as of September 28th that we are delivering this. And then each slide that we will go through has an as of date as well. They're all within the last, I'll say, week with various data points. So just be aware of that. And to that note, we are recording it. We will make the recording available. We'll both post it to our website, where we have a lot of recordings available, a lot of different materials for folks to access, but will also be available to email out to folks if you want to listen again or share with friends or colleagues. As many of you know, we love quoting Warren Buffett, one of the most quotable investors, they'll say, and thought this is just another great Buffett quote: "The market is the most efficient mechanism anywhere in the world for transferring wealth from impatient people to patient people." And I know, we obviously get caught up in the day-to-day, week-to-week, month-to-month, quarter-to-quarter, right, of all the machinations in the market and movements. But it's always important to just remember that probably the most important attribute to investing is being patient, right, and keeping your time frame in mind. And we'll talk more about that as we move along. But let's dive into some of the weeds. Let's dive into what's kind of been going on, what's going on now, and what we kind of see through the end of the year. Now, I'm going to let Alp kind of take the lead from here.
Thank you, Jason. I'll start with this. The current economic environment makes it virtually impossible to issue an economic forecast with any degree of confidence. On March 1st, 2022, so it's before the first rate hike, so it's 18 plus months ago, if I told you that we would be facing the following headwinds on September 1st, 2023, how do you think investors in the markets would react? A prime lending rate of 8.5%. It was 3.25%. 30-year mortgages, 7.5%. And let's not forget where we were. We had 15-year mortgages at 2%, 2.25%, 30-year mortgages, 2.5% to like 3.25%. So major changes there. New car loan interest rates, 12.9%. That's with a good credit score of 750 or above. You are now seeing some dealers offer ultra low rates. They're trying to keep the prices higher without having to basically cut prices, so they can just lower the rates instead for now. Average new car loan payment, $725. $600 billion of what they call unrealized losses on bank balance sheets. That's from their conservative investments, buying longer dated treasuries. Interest rates have gone up, so the banks have lost a lot of their reserves, and the rules are such that they don't have to actually recognize that loss if they're not planning on selling it. So if they're holding the bonds to maturity, they're fine, but it's really interesting how it's taken away a lot of their capital. Valuations in commercial real estate down 20 to 30%. There's some news that came out just yesterday. I think Meta, which is Facebook, just bought out a London lease. They basically vacated a building because of the remote work and paid, I think it was $147 million, which was 7 years of rent on the building. But the point I'm making is a lot of the office buildings are devalued substantially from the, I'll call it, lack of new office leases, people shrinking their offices. And so that's a problem. We've got the office valuations down substantially. And the question ends up being, who's holding that debt? Student loan debt repayments starting in October 2023 after a 3-year hiatus. Credit card debts exceeding $1 trillion. And it's probably more fair to say that they're at record levels right now. 4 US bank failures in 2023, including Silicon Valley Bank, Signature Bank, First Republic Bank. They're the 3 big ones. Heartland was a smaller one. Higher for longer interest rates through 2024, which is what the Fed's have been saying over and over lately. And I'll say a larger by the day trade war with China and the war in Ukraine still going strong with no end in sight. So if you knew all of that in April 2022, you'd probably be really surprised at the market's resilience today. I know I personally have been. It is something that when you look at all these headwinds, the market always deals with headwinds and it has this marvelous ability to look ahead. But right now, I tend to think that we're at a period that's really difficult to figure out what to expect over the next 3, 4, 5, 6 months. One thing I'll point out on this, the divided economy, that's a comment we've been making a lot lately. Federal Reserve talks about the strength of the US economy. I think they're ignoring about half the population that basically are renters. And I'll say they have credit card debts and the credit card interest rates are higher. And they have, as we mentioned earlier, record credit card debts. And so I think they're ignoring a major portion of the population that really is suffering right now. Another topic we'll talk about a little later on is investing for yield. It's basically, for the first time in a long time, there's alternatives to invest in the stock market because there's a lot of bonds out there that are paying US treasuries that are paying 4, 4.5, 5+% right now in the bond market also. So there are alternatives to the market.
Yeah, it's quite the list of challenges there.
It is.
It's not all bad, but.
Well, again, the market always has this ability to look ahead, whether it's 6 months, 12 months, 18 months. So in my mind, when you look at where the market is right now, they're basically saying, we think this is going to be shorter term problems. I'm not as certain about that, but it seems like the market is laying their bets that way, at least for now. So what we have here is a slide we've gone over a lot in the past. S&P 500 index at inflection points. On the far left, March 24 of 2000, you see the tech bubble and the forward price to earnings ratio at that time, 25.2. The higher that number, the more expensive the index is, the lower the number, the cheaper it is. Middle of the page, October 9th, 2007, forward PE of 15.1. So going into the credit crisis, the market actually wasn't that expensive. You can see we actually went sideways for about 10 years. If you just look at that, the peak of the tech bubble to where we were going into the credit crisis, big sell-off, down 57%. That's when Warren Buffett was pounding the table that US equities were cheap and forward P was 10.4. You see that long rally all the way to the start of the pandemic. And then you saw the fastest bull market to bear market reversal. And then with all the stimulus that they threw into the economy, the fastest bear market to bull market reversal and a really strong trend line going almost straight north. And when that was happening, our view was that that's not sustainable because you see a well-defined trend line and all of a sudden a change in direction. A lot of that was very, I'll say, correlated to all the meme stocks. People were just being a lot more speculative. It wasn't able to be sustained, and you see a fairly big correction during 2022. And then you see we kind of traded along the trend line for a little while. And then in January 2023, we actually took off mostly, and we'll show you later, mostly driven by what they are calling the Magnificent Seven. But the forward PE right now through September 25th, 18.1. And to put that into context, the next slide shows you the 25-year history of the forward PE in the middle, 16.76 average. You see on the far left, you can see how expensive the market got during the tech bubble. And you can see where we are today. Had a little bit of a pullback, and it's pulled back even further from that right now. Market's not really expensive. In no way, shape, or form is it cheap like it was during the bottom periods during the credit crisis. Not expensive, not cheap. A lot will depend on, do we actually end up having a recession at some point in the future? And if we do, does it impact earnings dramatically? So that could change the PE ratios substantially. But right now, when you just look at the market overall, not expensive, but clearly not cheap.
And again, you can see the clear move with the pandemic, right? Fell off a cliff, straight vertical, got really expensive. As you commented, was not sustainable.
So this has become my favorite slide. So this basically is, I'm looking at the left side of the screen, the price to earnings ratio of the top 10 stocks in the S&P 500 versus the remaining 490 stocks. So if you can see a great lesson of history repeating itself, if you look on the left side, you can see basically what happened during the tech bubble, driven by, the Microsofts of the world back then, AOL, Lucent, Nortel. It's not the same cast of characters that led the same disparity to happen on the 2021, 2022 side, but you can see the chart action. Basically that unwound on the left side, and for about, looks like, 12 years, 14 years, basically the market traded in tandem, the top 10 stocks and the rest of the market fairly close to each other in price to earnings ratio. And around 2016 and 17, when large cap growth started to separate from the rest of the market, the Apples, the Amazons, the Microsofts, the Googles, Nvidias, Tesla, Facebook, those names, and actually they include a few non-tech names like Berkshire, Exxon, and United Health, but the main action was literally driven by the tech. You can actually see that their price to earnings ratio got high again. Struggled a little bit there for a while, and then in 2022 came back down close to reality. Big sell-off in large cap growth, about 30-35%. P ratios became a little bit more reasonable, and then the beginning of this year rallied back again. And the question is, was this rally sustainable? And I tend to think you're going to see more of this come back to what happened in the past. You'll see the P ratios of those come back down. Now, can that happen by earnings growing substantially? Yes, but it could also happen from just the prices coming down. And you've seen some contractions in certain ones. Again, you're seeing the start of it. Not sure where this is going to bring us longer term.
And this is kind of your earlier comment, the Magnificent Seven, right? Those
question.
Growth, specifically kind of top tech names that you went through. Yeah, that's where all the action's been.
Yeah, so this is just a slide that kind of talks about the same thing. It's the large cap growth names. So if you look in the middle of the page, the year-to-date area, you'll see large cap growth basically up 25.9% through September 25th. On the flip side, large cap value 3%. And I think just in this last week, we're showing that some of the value names are actually now flat for the year. So despite the S&P being up a decent amount, I think right now we're up around 13% or so in the S&P, you've now seen only the growth names actually participating. So again, these numbers are actually down in the last week, but if you take a look at it, the value stocks are all relatively flat. Growth across the board up more than their value counterparts. And if you go to the right side, you can see the current price to earnings ratio versus the 20-year average. And so if you look at the value side, You see large cap value, current PE 13.9, 20-year average 13.7. So across the board on value, actually very, I'll call it very in line with the 20-year average. And if you go on the growth side of the equation, driven by those big names, you can see that's where the abnormalities are in terms of the P ratios. On the bottom, they put it in terms of percentages. On the bottom right, you can see large cap growth basically selling at a 31% premium in terms of the PE, but the rest of the market actually fairly reasonably priced, which is fascinating.
And Alp, we had a question, just kind of thinking about the markets and its impact on the retirement landscape, right? Today and kind of into the future. And I know that's a big question, right? And there's a lot of different ways we could go with that. But I wanted to make one comment here and thinking about, it's not uncommon. And in fact, I'll say it probably is very common that as folks are in retirement, their portfolio generally reduces somewhat, not to zero, but reduces their allocation to the growth side, right? And starts shifting more to blend and value, dividend paying kinds of stocks. And so for many retirees, and it's a very prudent kind of move, right? To kind of ideally smooth out the returns, generate more income in retirement. Within a market like this, some retirees are looking at a portfolio in the short term that may be underperforming relative to portfolios that have been more growth oriented.
Without a doubt. And if you look at the 3-year returns between growth and value, what's really interesting, because growth took a beating during that 3-year period, it dropped 35% in 2022. You'll actually see that the value stocks kind of staying flatlined for a couple of the years actually have outperformed growth over the 3-year period. But it's what have you done for me lately, where people get disappointed when you take a look at what growth has done in 2023 versus value. People tend to want a little bit more growth exposure in their portfolios, which again, depending on where you are in your overall retirement savings, it can become I'll say, adding too much extra risk into the portfolio.
I think it also
something to talk about.
Reinforces, right, the notion of diversification, right, and not getting too conservative just because you're in retirement, right? Because most people have a long retirement window and they need some portion of their portfolio to continue to outpace inflation and have an allocation to the growth.
This next slide is actually probably the busiest slide that we ever put up. So this is the S&P 500 index broken down into its 11 sectors. And we're only going to look at basically one line in it, and it's this year-to-date line. And so if you take a look at it, so at this time, the S&P was up 14% on the far right. But if you look at the various 11 sectors within it, you can actually see a lot of them have not really participated. Like Jason, the line, he's going from right to left. Utilities down 8%, consumer staples down 3%, healthcare down 2.5%, which is usually a very defensive sector. Real estate down 6.8%. Communication services up 41, tech up 35.5, and consumer discretionary up 27.9. So these are all weighted by the largest stocks in those particular sectors. So consumer discretionary, where I show it up 27.9%, 2 stocks make up 42% of that index. That's Amazon and Tesla. And they're up a lot. It goes back to that Magnificent Seven comment. Yeah. Technology, 2 stocks again, Apple and Microsoft make up 46% of that. So again, they've driven that number up higher. And then communication services, we've got Meta, which is Facebook, and Google making up 46% of that index. So again, if you look at the rest of the market, other than energy, and industrials have kind of picked up a decent amount this year, but energy has been running the show for the other sectors. And that's primarily because the cost of oil, we'll show you in a slide, has actually started moving back up again. But an interesting slide. So I don't know, Jason, if you want to chime in here, since this is one of your favorite slides.
Sure, we always like including this slide, kind of taking a step back, historical context a bit here. So this is just the S&P 500 annual returns as well as intra-year declines. Okay, so going back to 1980, just kind of give us a quick lay of the land. The bar chart represents what the S&P returned for the year. So in 1980, the S&P finished up 26%. And so as you scan across, you can see the majority of the years finished positive. In fact, 32 of the last 43 years finished the year positive. But in every instance, intra-year, so at some point during the year, the markets sold off. And that's what the red dots represent. And so that shows the largest intra-year decline in each year. So again, to use 1980 as an example, finished the year up 26%, but at one point was down 17% during the year. And you can see very normal that there'd be actually, double digit or good sized downturns. And in fact, the average intra-year drop is over 14%. And we come over to the far right. So year to date, here's where we are as of September 25th on this slide. Yep. Was down actually at 1.8%. Last year, finished the year down 19, at one point was down 25%. And kind of it was sort of the opposite theme, right? I'll mention this, but those Magnificent Seven names, in essence, were the worst performers last year, all right, and have reversed out now as we've been talking a lot about the best performers this year. I guess the one commonality is energy was the best performer last year, and it's
recovering
continued
again this year. Yeah, it's done well
to participate. Yep.
But it also was a horrible performer, surprisingly, for 7 or 8 years.
Yeah.
Right? So,
Yep. And you can see the credit crisis, right? 2008, down 38%. It was actually down almost 50% at one point. Started the year, so as of I think it was March 9th, it was down another 28% to start the year, but then recovered and rallied up to finish the year up 23%.
Just a great reminder of at times how much the market can move within a year, but over the longer haul, still generally being a lot more positive than negative.
And just how normal that there's a call it 10% or even 14% on average drop in any given year.
Yeah, like right now, year to date, I won't say year to date, but just this recent pullback in the market, we're down about 7% from the highs. And so people are starting to feel a little nervous, but again, that's actually very mild in terms of corrections right now, or pullbacks.
Yeah.
So this is an interesting slide that we've gone over for years and years.
Get your microscope out.
Basically, when you see the purple versus the gray, the purple is when the international markets have outperformed. And the last big cycle was basically in the 80s, where international outperformed the US markets by a wide margin for 5.6 years. But then since then, it's been US market dominance. And so this has been a massive outperformance cycle. But now we say, is this the start of something new? We've been waiting for this for a long time. We don't know if it's the start of something new, if it's just a short-term blip, but you're actually seeing the international markets basically outperforming for a short period of time.
So if you're looking at this on your phone, you got to zoom it in.
Yeah, it's tiny, without a doubt. But again, so is this the start of something new? Again, we've always seen the cycles reverse historically, but then, 2 of the last 3 cycles have been a substantial US outperformance. This shows you international valuations versus the US. And so on the left side, it actually tells you that on average, international markets, basically their PE ratios are at about a 16% cheaper, discount than the US. And if you take a look right now, it's at about 31% at the bottom. So international markets are really cheap compared to the US markets. The question is, will that reverse at some point?
As we saw in the last slide, they've been cheap for a while.
Yes.
Relative to the US.
Yeah, at times we'll joke, it's like Walmart pricing. The prices have stayed low for a while. And you also take a look at the dividend yields, which is something that's really favorable for the retiree investor. And that's why you see a lot of the retiree portfolios through the asset allocation funds, that they're actually putting up higher percentage to international because of the higher dividend yields to sustain income flow during retirement. And right now, basically we got a 1.7% higher dividend yield versus the US markets overseas. So the fixed income markets, lots of opportunities here for the first time in a long time. So this is similar to the chart that Jason showed you earlier, but this is now the Bloomberg US Ag, like the total bond market. It shows you the annual returns in that index versus their intra-year decline. So basically the same thing as before. Difference is the numbers are a lot smaller in the downside in the bond market, with the exception of the far right. So you can actually see, even in the high interest rate years on the left side of the equation, remember there was mortgages back then of 15, 18, 19%. So in CDs and banks, 15%. But in those years, like it looks like around 1979, 1980, 9% sell-off at one point, but then the bond market recovered to be up 3% for the year. So you can see, like, rare to have big sell-offs. Towards the middle, we had a 7% sell-off, but mostly 2, 3, 4, 5%, the biggest sell-offs. And most years overall, the bond markets have been up. Big abnormality, having trouble to pronounce that word today, but in 2022, bond market at one point, with the Feds raising interest rates, down 17%, finished the year down 13%. Year to date, it's down about 1%. One point it was down about 5%. And so this is the big debate. Do we have opportunity here for the first time in a long time? There was a number of years in the bond market where the returns in the Fed's low interest rate cycle, returns were on the lower side. And so now treasury yields, corporate bonds, high yield bonds, all yielding substantially more than they have in the past. And I'll say there are alternatives. There was an acronym, TINA. There is no alternative to investing in the markets. And right now I just saw a new one that there are multiple alternatives. So they're actually changing it a little bit, saying there's a lot of opportunities outside of the equity markets to get, I'll call it, locked in returns, especially with US Treasuries. You can get the 10-year right now at about 4.6%. We don't know how long that will last, but that's what the opportunities are right now.
Yeah, we talk about it a lot with clients. If you have cash sitting in the bank, and if your bank's not paying you much in interest, there are plenty of other banks out there willing to pay you 4.5% interest.
No question. Probably one of the easiest moves to make too. I mean, just to move it around.
So
always being mindful of the FDIC limits, of course.
Right, $250 per person, $500 for a couple. Yeah, what's the acronym for multiple alternatives?
I thought they were saying TIMA. I think they were just saying there is multiple alternatives now. So it went from TINA to TIMA.
TIMA.
So this just shows you what the yields now are in the bond market. So you can see 2-year treasuries, this is through September 25th, 5.09%, 10-year at 4.55, 30-year at 4.67, which is really attractive for pension funds. They can lock in, 4.7% for a long period of time. That's a big offset to the accruing pension liabilities and pension funds. And then you can just see like convertible bonds, high yield. You can see the various yields, but because rates have actually gone up this year, you could have actually lost money principal-wise. Doesn't mean you're not yielding. If you bought a 10-year US Treasury that was yielding 3.8% earlier in the year, you're actually making money on the yield. But year to date, basically, you'll see the value of your bond decrease. It'll still mature at the value that it's supposed to mature at from when you bought it. But because you can now get a higher yield in a 10-year Treasury, your current one will get discounted. So the way it works is just simple math, that if you have one that's yielding 3.9%, you could buy one for 4.55, they'll make it so the total return in both bonds will be the same over the remaining period, basically by discounting your one that's paying 3.8%. So you'll actually get a little bit of appreciation at plus the 3.8% yield.
Yeah.
Sounds more complicated than it is, but it's just pure math.
And really the number to focus on in bond investing is the yield to maturity, which takes into account the coupon or the interest or yield that it's paying you, plus what the price you paid, right? Did you pay it at a discount? Did you pay for it at a premium?
So the state of the economy, I'll say the next few slides, we've got a number of slides that kind of just show you where we are today. This one just basically is telling us that trend growth is back to where it was. And the reality is the trend growth for the last 20 years has only been about 2%. We're going to have a period where there could be higher growth in the third quarter. The estimates are all over the place, and that's one of the things that has the Federal Reserve a little bit more worried. But there's also a lot of people that believe that it takes a long time for the rate hikes to actually get fully filtered into the economy. And many people believe there's signs of a slowing economy in the fourth quarter, but the Feds are a little bit more focused on the third quarter growth could come in higher than people had anticipated. But overall, if you just look at the trend line, it's generally a couple percent growth in the US, and that's despite substantial deficit spending since 2007, 2008, where I think we've probably added, I'm going to guess, close to what, like $20 trillion to the US deficit. And with all of that, we're still just getting mediocre growth in the economy.
Yes, debt. Yeah. And just shifting gears, a comment you made earlier, you talked about the Fed talking about the strength of the economy, and what often then gets talked about as well. It's really the strength of the US consumer. Right. And so for folks, you hear the term the haves and the have-nots, the divided economy. Right. And so folks who maybe have a home paid off and, haven't had their income disrupted, haven't necessarily been hit with inflation in the same way that renters have and so forth. They've been spending. Right. There've been a lot of pent up demand that gets talked about. Right. And and you can see the components of GDP. It's almost about 68% is just from consumer spending. All of us spending money, buying things, traveling, so forth, and that is kind of propping up things right now. The folks that have money are out there spending it.
If you've locked in that long-term mortgage, if you have a mortgage on your house, I mean, you've had zero impact from the housing inflation, other than the repairs on your house have gone up in cost. But compared to the people that are paying rent, I think that's one of the reasons the consumer spending has stayed much more resilient, because it's just a huge portion of the population has refinanced over the last 10 years to those low rates. And I can't tell you how many times we have clients telling us that have kids that their kids are paying more in rent for a 1 or 2 bedroom place somewhere compared to the parents' mortgage payments.
Yeah, and what a challenge it is now for a true first-time home buyer, right? Somebody who's not selling a house to then buy a house, but just really trying to get in the housing market for the first time, to buy a house at 7.5% mortgage rates.
So now this is kind of the first, what I'll call depressing slide. This is the federal finances. So the 2023 federal budget, looking on the left side, total spending, $6.2 trillion. And to make ends meet, we all wish we could run our households like this, but we can actually make ends meet in the US by borrowing $1.4 trillion. So if you look at our tax collections versus our expenditures, to fill that gap, we're actually increasing our deficit. So that's, to us, a problem. And if you look at the federal net debt on the bottom right, as a percentage of GDP, you can see in 2023, we're basically rivaling World War II levels. But the problem is, if you looked at this slide 3 years ago, the CBO forecast for the next 10 years had this line going sideways on the far right. So if you look at that forecast area, now it's trending higher. And my understanding is next year they're expecting at least a $2 trillion deficit. And one of the things that has become a problem is the interest outlay that the federal government has to pay now that rates have gone higher, which is one of the things that I struggle a lot with. So if we've got 33 trillion of US debt and supposedly a fairly substantial portion of it maturing in the next couple of years, meaning that they're going to have to refinance that debt with the newer rates. It's basically the exact opposite effect of all the years. If you've had a mortgage and you've refinanced, kept getting lower and lower rates. This is the opposite. Think of refinancing and paying more. Not very appealing. And you can actually see on the top, like the net interest outlays are getting more and more expensive. So this is something that I'm keeping my eye on. Again, hate seeing this forecast into the future, our deficit going up. Consumers on the next page, I'm going to skip the left side. What I like focusing on the right side, top right, household debt service ratio. debt payments as a percentage of disposable personal income. See that fourth quarter 07, about 2/3 the way across. You can see debt payments was getting really high, up to 13.2% of somebody's disposable income. All the refinancing, you can see how much that came down. So that was really great for people that had mortgages they could refinance. They saved a lot. But for the person that was the renter that had credit card debts, didn't help as much. This is being heavily weighted by those that had mortgages. You can see we went sideways for a long time because we were in that low rate cycle for a long period of time. And then we actually got even lower going into the pandemic because people did the right thing with a lot of the pandemic cash. Plus, they weren't spending that much money in the early periods of the pandemic and actually paid down debts. So what has changed now is the basically household debt service ratio has increased back to where we were, but what's more disturbing is the trend. So if you look at the bottom right, the flows into early delinquencies, and you can see on the right side of the screen, you can see the auto loans in blue, credit cards in gray, and you can actually see those delinquencies increasing. And the one on the bottom that's laughable, the student loans, was going sideways because they didn't have to make any payments for 3 years. So I'm guessing this particular one is going to be probably the most vertical spike there is, with one exception. I think the government's figuring out ways not to consider the loan being delinquent, which is going to be a little bit misleading. But my guess is this is actually going to cause some problems in delinquencies. I think we've already heard that from a lot of people saying they just don't have the money. I mean, I think, and I'm not trying to make a political statement, but I think leaving it at 3 years without making payments in the strongest jobs markets that we've had in basically modern history didn't really make a lot of sense. I think people got used to not making that payment, too used to it. I think there's some people we talk to that basically
adjusted their lifestyle.
Yep.
Sorry.
Yeah, I think some people did the right thing, but a lot of people didn't.
Right.
And I think it's really tempting to not, I'll say it's really tempting to just get used to like that new cash flow.
Yep.
Especially after a few years and the promises that the administration was making, they would cancel some of the debt. So this is one of the big worries of the Federal Reserve. The labor market, the jobs market has been really strong. So you can see March 2022 that the job openings right now, that is starting to come back down. So the trend line is in the right direction. So that is a huge positive. And we've seen it just in our own office when we've put out just job searches. We're getting a lot more responses now, and I'll say good responses, where before you probably could have discounted 90% of them as unqualified. We're now seeing a lot more qualified people looking to move around. So that's a big positive. So to me, this is something that we know the feds are hoping will continue in this right direction. However, I will say, personally, we've always felt that this strong jobs market was a positive for the economy, and for the feds to be too focused on it, in our opinion, is a mistake.
Focused on increasing unemployment, right? Which is seems counterintuitive.
Without a doubt. And again, I understand what they're trying to accomplish. I think they're too focused on trying to get back to their target 2% inflation. I think next slide shows you a little bit more on unemployment and wages.
And I know we had a question around inflation, just letting folks know we got plenty of slides. We're going to talk about that.
So this kind of just shows you the wage inflation we've had after a long period. So in blue, a long period. So we would have investment committees with 401k clients and pension plans, and we'd talk about at some point, the feds wanted to see a little bit more wage inflation. They wanted to see, for a while, remember, they wanted to see more inflation than they were getting because inflation was just uncharacteristically low. So obviously we got a little bit more than the feds wanted. So you're seeing wage growth that increased substantially. It's pulled back a lot. So that's a big positive. I will say, though, we're now starting to see a lot of pressure from the labor unions. And I know the UPS contract had fairly substantial gains. I'm guessing the UAW one will have fairly substantial gains. So it'll be interesting to see how much that affects things on a going forward basis. But I think the problem there where they were behind the times on some of the labor contracts because they were locked in. They weren't getting the increases that the public markets were getting. So I'll say I think the labor unions are now benefiting from what they didn't benefit from in the past.
The timing of their contracts.
No question. Yep. It's actually great timing. This just shows you housing inventories. Everybody knows this, that if you look around your neighborhood, the one thing you very rarely see is for sale signs. And a lot of that's for the obvious reason that unless you can pay cash for the next house, not many people are going to sell their home if they're only paying 2.5% to, let's call it 3.25% on their mortgage.
Sell the home and give up that amazingly low mortgage.
And refinance, or not refinance, but get a new loan
buy
in the 7.5%. So I've actually been surprised at the resilience of the pricing in the housing market, but I think it shows you that there's just very little inventory out there, and people that are jumping in now, if they're not paying cash, I think they're completely betting on they'll be able to refinance that rate later on. Housing starts pulled back a decent amount with the higher rates, but it's recovering. The rental vacancy rates, again, this is a problem because there's just very little vacancies. We know that's picking up in certain cities that have some of the highest vacancies. There's a lot of buildings coming online, so that's a big positive. Multifamily housing starts, so trying to build more apartment buildings. Again, what we've heard is very few people are starting new projects right now, and they're going to wait until they can get better financing. And the problem with that is we need more housing. So to some degree, it adds fuel to the fire when it comes to housing inflation. We just don't have enough apartments out there, and we don't have enough housing out there.
I think DC kind of continues to be in abnormal, to continue with that word theme, market in that regard. There continues to be holes being dug and big buildings going up, it feels like, all over the city. But I think that is abnormal right now when you look across the country.
So this next slide is a great slide when it comes to the bank assets and liabilities. So the left side is the large banks, top 25 banks by domestic assets. The right side is all banks outside of the top 25. And so one of the worries that is out there is, where are all the commercial real estate loans held? Predominantly in the smaller banks. We're holding 44% of those loans. And so that actually is a problem for the smaller banks if those banks, if the debtors start defaulting. And most people don't know this. Commercial real estate, most of those loans are what they call non-recourse. I'll put it in simple terms, that let's say you borrowed $100 million to buy a building. If your building is now worth $80 million and your loan is still at $100 million, with a situation when it's non-recourse, you can basically just hand the keys back to the lender and walk away. And so that's one of the problems out there with the smaller banks, is how much of a problem will they face with commercial real estate defaulting. I know San Fran has had some fairly nice hotels, I think a couple $100 million loans on them, that have actually defaulted, and you're seeing apartment buildings even around the country, even with rising rents. If it was an apartment building that had a bad loan on it, if somebody bought a building and they might have bought it with a variable loan on it and didn't expect the rates to creep up as much as they had, we've even seen some buildings, apartment buildings with the higher rents go into default.
Yeah, and it's troubling because the smaller banks have traditionally, as seen here, been the primary lender to small businesses, and so if they're struggling from their loans on the commercial side, that can have a ripple effect on their lending to
That's
small
a great
businesses.
Point. Yeah, I mean, I think if you look at that, it's not only are the interest rates higher, but the banks are more resistant to giving out loans right now because they're trying to protect their own capital. So they might be taking the rates up even higher than normal, basically. So if the prime rate, as we said, is 8.5, they're going to take it up even higher, basically to give them some kind of compensation for the risk they think they're taking on. So it's really becoming more difficult for small businesses right now. Oil markets is just a reminder of one of the components of inflation. And you can see on the right side here, you can see oil prices moving back up, and they've kind of spiked up lately. We've had some cuts in production in the OPEC countries. That's driving it. The reality is if we have a recession, that usually lowers consumption a lot, and you'd actually see oil prices coming down. But a lot of it is just the computerized trading programs. Oil's been on a run. Whenever you see some of those spikes, they keep pressing their bets. So it'll be interesting to see what happens here. A lot of the oil strategists that I follow, they think we're definitely going to see $100 oil. The question is, will it be sustainable?
All right.
Yeah, so this is like, yeah, some of the good slides on inflation. And I think the first one's one that just shows you what the Feds are worried about. So if you look at the left side of the screen, so this is CPI and core CPI. Core CPI basically is excluding food and energy, the more volatile parts of inflation. So if you take a look at CPI on the left side, the Fed's biggest concern is what happened in the late 70s and early 80s is they had runaway inflation, got control of it, and then it spiked up even more. And so if you look at what is happening on the right side, we see our spike up there, come back into control. It's actually at a reasonable level now. The Feds aren't happy with it. They want to get to their so-called 2% target, which I think is going to be harder with wage inflation being higher than normal. And again, with energy prices being higher recently. So this is the worry. So we are seeing shorter term, some inflationary pressures coming back up. But so the big bet will be, will this move up measurably? Most people think that it won't, but there's enough out there that's causing a lot of volatility in the markets. But again, the Fed's big worry is that double peak on the left side. After years of almost no inflation, though. I mean, that's something that, they wanted more inflation than they were getting.
But not to the upside that they ended up getting.
Without a doubt. Yeah, definitely obviously caught the Feds off guard, and which is something to note. And when we get to a certain slide, I'll remind everyone that the Feds, when they're talking about their forecast for the future, they were really bad in their forecast in 2021. And we'll go over that in a little bit.
I know we had a question around kind of the recent economic data and Fed actions affecting kind of the markets, and then more specific out to address kind of how that has impacted our thinking on relative weighting to bonds and stocks.
No question.
And portfolios. Yeah.
I mean, it's made the fixed income more attractive for the first time in a long time. However, we're still getting pain in the fixed income markets because the yields have been moving higher, and recently that's been a relatively big spike.
As we saw in that earlier slide, right? That if rates are higher than at the time you bought your bond, your principal value of your bond can actually go down.
It'll still mature at full value, but again, on a temporary basis, it gets revalued. So these are the inflation components, and on you can see the biggest in navy blue is the housing and shelter inflation. You see, it makes up the largest part. Most other inflation is actually starting to come into check. One that's been a little bit stubbornly higher. Anybody that's going out to eat notices that the restaurants have been more aggressive than they've been in a long time. I mean, for years, I've always felt that actually going to certain restaurants, I'll call it like the mid-price restaurants. I'm not a big foodie going to the expensive restaurants, but I've always felt that when you look at the cost of the food, that restaurants just were not paying themselves enough for all of their services. And I think they've been making up for it, where they've been raising prices much more quickly. I know my wife and I were up in Boston at Faneuil Hall, and at one point we went to one of the food court vendors in there, and it was shocking. The guy was basically selling like a $50 dish. I asked him how much for this, and this, and he's, oh, that's like $47. And I just looked at him, I was like, are you actually serious? And he was just, I think, being very aggressive. It was, I think, high quality food, but I don't think in any way, shape, or form warranted the price that he was trying to charge. But if you look at some of the components now, you see energy, again, that was helping us for a long time because energy prices have come down. That's going to start hurting us a little bit. You've seen car prices come down. Again, it'll be interesting to see if that will continue with the labor strike, where we start running a little bit lower on inventory in car. Right now, there's plenty of inventory.
Yeah, and when we were looking at this slide, maybe 6 months ago and even earlier, the red portion, was massive. It was a huge contributing factor, but has come way down and in fact has now been deflationary.
On the right side, this talks about core services and ex-shelter. Basically, and a lot of it is like
Excluding shelter.
transportation services. It gives the definition primarily includes leased cars and trucks, motor vehicle insurance, and motor vehicle maintenance and repair. I will say I've noticed, because they're trying to get rid of inventory, new lease car prices have come down substantially. I've seen some big drops. I think for a long time they were able to ask whatever they wanted, and now again, as inventory has creeped up, so we should see some of those major components come down substantially. But again, inflation, short term, a little bit of a worry. We're seeing a little bit of a spike up, as you mentioned, because of energy, but overall trending in the right direction. The Fed and interest rates. This just shows you their history of, I'll call it how inaccurate they've been in their moves. And so if you look on the far left, going into the tech bubble, they were raising rates to slow the economy. And there's like a big whoops there. They only had them up there for about a year, and then they cut rates dramatically. Again, around 2003 timeframe, they started inching the rates back up, only for a short while. And then we had the credit crisis. Again, very short period of time, cut them down to zero. And probably one of the mistakes they made, they should never have kept them at zero. I've always felt that had they gone to 1.5% and 2% back then, it probably would have had very little effect on the economy. But you can see around the 2015 timeframe, they started raising rates. They went up 9 times. But most people forget that they actually made 3 cuts prior to the pandemic. They actually thought rates were too high. So when we had got to 2.25, they cut rates 75 basis points. We were at 1.5 at the start of the pandemic. Then they did an emergency cut basically to zero again, overstimulated the economy. The Feds, in their good forecasting, I guess it was in 2021, when they were asked what their expectations were for 2022, they felt that rates would be at zero for all of 2022. That proved to be really inaccurate. And so I personally discount their forecast for the future, the Fed dot plots. It's just a question of when it happens. I struggle with the economy being able to maintain these higher rates. And you hear a lot of different reasons right now that the Fed's going to have to refinance a lot of debt. That might be why they have to pay more on their debt. But I struggle thinking that the economy can handle rates after such a long period of time with lower rates. I think it's going to be really difficult if they have to maintain mortgage rate. If the mortgage markets stay at 7.5%, to me, that's a struggle.
Alp, let's just expand for a moment on kind of the question that came in, kind of on how sort of this, what we're looking at here, right, is impacting accounts, right, allocations, and really just broadly speaking, the mix of bonds and cash, I'll say, right, and equities.
Well, for the first time in a long time, you can actually get paid for just having money on the sidelines. Remember, we were at zero. And one of the things that we talk about a lot with clients in meetings is if they've got money at some of the major banks like Bank of America, JP Morgan, Wells Fargo, Citibank, yeah, they basically pay zero on their savings, even in their CDs. You've got to go to the smaller banks to actually get yield. And we're seeing a lot of people move there. So you can now get money markets yielding 5.25%. You can get CDs, 4.5 to 5.5%. So it's an attractive alternative. We talked a little bit about this earlier, and it is providing some competition to the markets. One of the things that's been interesting is if you were a retiree that was trying to replace the zero interest income you were getting in the banks, and you were buying some dividend paying stocks, and the dividends were 3.5, 4% for some of the dividend payers, that looked really attractive when rates were at 0%. When rates have moved up, the money markets are now, as we said, at 5+%. That makes the dividend paying stocks on a temporary basis less attractive. And so you've seen some problems there where they have not held up compared to the rest of the market. So basically, by offering opportunities outside of stocks, there really are a lot of investments you can look through right now to diversify your portfolio that will provide returns. Now, there's been a little bit of pain holding the fixed income right now, but I think if you were to now look out for the next 10 years, it's probably a relatively good place to be. The only way you might want to reduce exposure to fixed income, I'll say it's going to be multiple years in the future. If the Feds at some point have to cut rates really low again to stimulate the economy, it would probably make sense looking at other alternatives again.
And Alp, I mean, I think we both get a version of this question quite a bit, is like, okay, so why, if I can just park it in a money market and get, in our client accounts, 5.25%, right? Zero market risk, equity risk, bond risk, right? Contrast that with a comparable yielding bond, right?
So great question. So I'll say that the big debate is, how long will the money market rates? So right now, what they call it, the rates are inverted. The short-term rates are higher than the longer-term rates. And that's generally a big warning sign for a recession, because the Feds are trying to slow down the economy. But the big debate is, well, if I can get a 10-year treasury now at, let's call it 4.65%, that means you will get that yield for the entire 10 years.
Mhm.
If the Feds have to cut rates, let's just say they come back down to 2.5%, your money market will come all the way back down to 2.5%, where you
Yep.
could have locked in the higher return for longer, not as high as the money market's currently paying, but you can lock in, as I said, 4.65 for 10 years. In the bond market, high yield market, you can lock in much higher returns.
And I think a lot of folks are familiar with bank CDs, right? And it's kind of analogous there, right? Thinking about, oh, well, if I can just put it in the money market and get 5% interest, or called a 5-year CD that's paying less because the yield curve is inverted. Why would I put it to get less? Well, if you think rates will come down, because money market rates will come down, as you said, you've locked in the 5 years.
And there has been, I'll call it the herd. A lot of the herd has moved into money markets. And historically, when there's been massive moves like that, where like a lot of people, I'll just say, are on one side of the boat, that's usually the time to move to the other side. However, I can tell you, it's shorter term. There's been a lot of velocity in this recent move.
So we're out. We've got,
couple minutes.
Couple minutes.
So this just shows you on the top right, the household excess savings. And this just, the big thing we're kind of focused on is just all of the extra money that was thrown in, the stimulus payments that were given to people, all of it's been spent, right? It's over with. There's, as we mentioned, record credit card debts. For anybody that still has the extra stimulus payments, my line has been, those are people that were never going to spend it to begin with, period. You were just giving somebody money that were great savers. They weren't going to change their spending habits. The rest of the country, when they got extra money, they held on to it for a little while, but now they've exhausted it. And it's proven out by the credit card debts. The dollar is a big issue. We get to ask this question a lot. The Feds, like chanting higher for longer, has kept the dollar stronger, because you're actually seeing the rest of the world starting to slow down in their growth projections. And so some people believe that despite higher inflation in some of those countries, by raising rates higher, they've damaged their economies, and they're starting to worry that they're going to have to lower rates. And so if the dollar stays higher for longer, that has driven the dollar higher. So if US rates, I'll say, stay higher for longer, that's driven the dollar higher. But what's been interesting, Janet Yellen has been out a decent amount lately talking down the dollar. She's saying that we're probably seeing a little bit, I think she's using the term de-dollarization, that will be more competition for the dollar around the world. So that will be an interesting trade, and that would enhance international investments.
International markets, yeah. And then we got to the question, we had a question around the recession. What do we see there? Recession in the forecast?
Yeah, so basically this is saying that, and this is what the markets, I'll say, the Federal Reserve has been afraid of, that they don't see anything in the future. So you can look at the red back going into the pandemic when we had that recession, right? These are the various factors that the NBER looks at before they make the call of if we're actually in a recession or not. And most people are saying that the economy is in a position right now, the US economy is showing decent strength, but there's plenty of people that are saying, however, it takes a long time for those higher rates to fully filter through the economy. And they're worried that you're going to see the economy more abruptly slow down at the end of 2023 and going into 2024. But again, This is the big debate, and I don't have an answer on it.
Now, if that happens, a likely response, right, from the Fed would be
to lower rates. However, they've been resistant to that because they, unless they come out and change their language, that they're not as worried about getting all the way to 2%. Right. So again, this is a really interesting time. No good answers. And I kind of started with my line of like, I think it's really difficult to make a accurate forecast longer term right now.
Well, and kind of to that point, another question that came in was, how do we factor in the unknowns? Things like the threat of China on Taiwan, the ongoing war in Ukraine and Putin, the upcoming elections. I'll throw in, the threat of government shutdown.
We got through the whole talk without talking about the upcoming elections. We'll discount that one. But we know that's on a lot of people's mind. But I'm going to say right now, there is a lot of uncertainty out there. So we like holding the more conservative investments in this environment, the more the dividend payers, thinking that the Feds at some point are going to be forced to lower interest rates. And we also think, when we looked at that JP Morgan slide earlier that showed the mega cap stocks, that their P ratios are going up. We think some of that's going to come back down. So we like where we're positioned. We like holding the fixed income. But to be fair, it is a difficult environment. And Wall Street as a line, it always climbs a wall of worry. And this particular wall of worry, in our opinion, has actually been a bigger wall of worry than we've faced with in the past. And so I think that's why there's a lot more uncertainty out there. So again, difficult question to answer, but it's easy to maintain the competitive, more conservative posture right now. And I'll have a slide coming up that kind of goes over that. That last JP Morgan slide. But
the quote.
Yep. Go ahead,
Yeah,
Jason.
let's do it. Let's do the quote here.
So I love this particular slide. I actually found this over the weekend. I wasn't searching for it, but I just happened to see a quote by JP Morgan. Nothing so undermines your financial judgment as the sight of your neighbor getting rich. And what do we mean by that is a lot of people get sucked into the market in the meme stock craze in the early parts of the pandemic. GameStop running through the roof, Carvana, Peloton, and they get sucked in because they hear their neighbors making money on it. And I think earlier this year, people were saying, oh, the large cap growth names are taking off again. And so I thought this was just a great reminder to get people to stay focused on what your belief is, what your
is a more modern term for this FOMO now.
Without a doubt,
missing out.
But it really is just like an amazing quote that I just stumbled across.
And I think it builds upon kind of the last point we wanted to make is that very few people are investing in a vacuum, right? You're investing for a purpose, right? To either buy a house, right, or retire and fund your retirement. And how important all of this data is relevant, right? And it factors in, but ultimately it's about you and your risk profile and your time frame and your tolerance for risk. How much risk do you need to take on? What's your overall financial capacity for taking risk, right? And building a portfolio appropriate for you. So it just always, at the core of everything we do, and want to emphasize those points. And I know we're running over the 1 o'clock hour. Any final thoughts up?
For us, I think it's easy to kind of remain cautious. We don't think in any way, shape, or form it's clear sailing. We hope we're being overly cautious. We hope we actually get through this and a year down the road, there is a lower interest rate environment and the economy can pick up momentum. But I'll say right now, all eyes are on the Federal Reserve and what they do and what their comments are going to be for the next 3 or 4 months. When it comes
very difficult, right, to predict the last quarter of the year.
Without a doubt. And when it comes to adding new exposures to the market, we've been big lately just on dollar cost averaging it in. So if somebody had a liquidity event and they have some extra cash right now, we think it's a lot easier to scale it in. Take your time, no big hurry. And also, we've talked about this a number of times, like bonds and even cash, as many people have said, look attractive right now. You can't be faulted for saying, I'll take 5 1/4 in a money market. But again, the however is, it doesn't make sense to put all your money there. We think it makes sense to put some of your fixed income allocation there if it makes you feel more comfortable. But we like locking in the rates that we're seeing for longer term in some of the bond market right now.
Yep. Well, thank you everyone for joining us. And as I mentioned, this is be recorded. It'll be on our website. We have a lot of recordings on different topics available, infographics, handouts, a lot of great material there. And as we started with, please don't hesitate to reach out at any point. Here's our good looking team. So appreciate you spending slightly over an hour with us. And hope everyone has a great rest of the day, and we'll talk with you soon.
And happy to field any questions if you want to shoot us an email.
Absolutely. All right.